Welcome to the deep dive. We cut through the noise to give you the essential insights on complex topics. And today, we're diving into central banks, specifically the U.S. Federal Reserve. We're going to try and unpack this big question. Do we actually still need central banks? Now, here's something that might surprise you. Almost every single country has a central bank. It's nearly universal. I mean, only tiny places like Tuvalu and Kiribati don't, and even they mostly use the Australian dollar for, serious stuff. But despite that, there's this growing noise, especially in the US, about maybe scrapping the Fed altogether. It's an idea that's grabbed attention from, well, global bank executives all the way to maybe more fervent online commentators.
It is quite a paradox, isn't it? They're almost everywhere, and for good reasons, really. In today's world, this highly integrated global economy with, gosh, dozens of floating fiat currencies. Central banks are this crucial check on, let's say, economic recklessness. They're an emergency backstop in a crisis, a mostly independent regulator trying to manage inflation and employment, plus they handle all the vital admin stuff that just keeps a currency working day to day. But what's really interesting, and maybe concerning, is how much harder those jobs have become recently. You've got this unprecedented global integration, debts just ballooning everywhere, and inequality making their usual tools, well, less effective.
That's a really fascinating point, that increasing difficulty. It's easy to just accept central banks are here now, but they weren't always, right? What was going on historically? What problems were they actually created to solve?
Well, yeah, their origins are quite organic, actually. It wasn't like a sudden invention everywhere. They sort of grew out of these informal European banking houses. Cities set them up, really, to manage their own debts and issue coins to make trade easier. The first formal ones, though, that was Sweden's Sveriges Riksbank back in 1688.
Oh, the one that gives the Nobel Prize in economics.
That's the one. Bit of trivia there. And then the Bank of England followed pretty soon after, 1694. And their early job was pretty straightforward. Act as a bank for banks and also for the government. Standardize the currency, smooth things out.
Okay, but the U.S. experience, that was way rockier, wasn't it? We actually got rid of our central bank twice.
Absolutely. A much more tumultuous path. The first Bank of America, 1791, that was Alexander Hamilton's push. The idea was sound. Remove financial friction, get a universally accepted currency going across the new states. Its notes were guaranteed, you see, so private banks took them. But politics got in the way. Its charter wasn't renewed in 1811. Gone. It came back briefly, the second bank in 1816, but then abolished again in 1836. President Andrew Jackson really disliked its power. That's a theme you see again and again, this tension between political power and these independent financial institutions.
And the result of getting rid of it? From what I've read, it was just chaos, complete financial chaos. You had regional banks printing their own money. How did that even work?
Barely. Imagine trying to do business across state lines. You wouldn't know if one bank's notes were good at another or what they were even worth. Forgeries were everywhere. I mean, technically the U.S. dollar existed, but getting actual paper notes was hard, so private banks just printed their own versions. It's actually an interesting parallel if you think about it. Those old private bank notes, they're not that different from our electronic bank accounts today.
How so?
Well, most of our money now is just numbers on a screen, right? Written down by private banks. We just assume, we trust, that those numbers will transfer smoothly between Bank A and Bank B. Back then, people hoped their paper notes would be accepted elsewhere. The security layer changed from, hard-to-forge paper designs to complex electronic systems now, but the core idea, it's trust in the system, even when it's kind of decentralized. Explaining the difference to an alien would be tricky.
Okay, so this messy system, these private notes, it eventually hit a wall, didn't it? That 1907 crisis sounds like the breaking point, a run on these independent, over-leveraged banks.
Exactly. It nearly took down the whole system. These banks were poorly regulated, took too many risks, and it actually fell to a group of private financiers, J.P. Morgan being the most famous, to step in.
As a sort of emergency lender.
Pretty much. A makeshift lender of last resort.
Yeah.
They pooled money to inject cash and stop the panic from completely collapsing everything.
Which must have made it blindingly obvious that a formal system was needed.
Undeniably.
Yeah.
That crisis directly paved the way for the Federal Reserve banking system in 1913. Initially, its main job was very specific. Stop bank runs. Lend money to member banks if they faced a sudden rush of withdrawals they couldn't handle.
Okay.
And then, fast forward a bit, 1933, another big step. Gold convertibility for citizens was suspended. That's really the birth of the paper U.S. dollar as we think of it now.
So looking back at that whole chaotic journey, the core goal seems to have been creating a reliable, flexible way to exchange value, Right, a stable currency.
That was definitely the consistent thread, yes, create a reliable and flexible medium of exchange. But over time, as more countries got their own central banks, their responsibilities kind of naturally expanded. People realized, hey, if you're the bank for banks, you actually have this really powerful lever. You can influence inflation, so the rate prices go up generally. And by doing that, you indirectly affect employment, economic growth, the whole picture.
And that broader role got formalized in the U.S.
It did. In 1977, Congress gave the Fed what we call the dual mandate: stabilize prices and maintain maximum employment. Those are its two big official goals today.
Right. But even with that huge mandate, the Fed's toolkit seems surprisingly limited. I mean, unlike the government, they can't just decide to hire 1 million people or build a bunch of bridges to boost jobs, can they?
That's absolutely right. They have immense influence, but very few direct controls. They really rely on two main levers. First, and most famously, is interest rates.
Okay.
If inflation's running too hot, the Fed raises its target rate. This makes borrowing more expensive across the board. So you earn more interest if you save, but pay more if you borrow. That tends to cool down spending by both consumers and businesses. Less demand usually means lower prices.
Like hitting the brakes on the economy.
Exactly. It's the brake pedal. And conversely, if they lower rates, borrowing gets cheaper, people might have more money after debt payments, spending picks up, demand increases, and prices tend to rise. That's the accelerator, sort of.
But wait, I don't borrow money from the Fed? How does their rate change actually affect my mortgage or a business loan?
Ah, good question. It's indirect. You're right. You don't deal with the Fed directly. The Fed sets the rate for banks borrowing from each other overnight, the overnight cash rate. That rate acts like a floor for the bank's own borrowing costs. So when the Fed raises its rate, the bank's costs go up, and they pass that increase along to their customers, individuals, businesses through higher loan rates.
Well, it's like a ripple effect through the whole system.
Exactly. It's not a direct switch they flip for the whole economy. It's more like a Rube Goldberg machine of influence. Fed changes rate, bank costs change, bank lending rates change, borrowing and spending change, then prices eventually react.
Okay, that makes sense. What's the second lever then?
The second one is open market operations.
Yeah.
This is where the Fed gets more hands-on in the market. Usually it involves them buying or selling government bonds.
Right.
And the most extreme version of this, which we heard a lot about after 2008 and during COVID, is quantitative easing, or QE.
QE.
With QE, the Fed essentially, well, it creates new money electronically, out of thin air, basically. And it uses that new money to buy up assets, not just government bonds, but sometimes corporate bonds, mortgage-backed securities, you name it.
Why do that?
The goal is usually to inject a massive amount of liquidity, cash, into the financial system during a crisis when lending is frozen up. Get money flowing again. The idea then is that later, when things are calmer, they can sell those assets back into the market, which pulls that extra money back out of circulation.
So they manage this big portfolio of assets they've bought. That's the Fed's balance sheet you hear about.
That's exactly it. And it's not like a normal company's balance sheet at all.
Yeah.
A regular business needs revenue or has to borrow money itself to buy assets. The Fed, it has this unique power to just create the cash it needs to buy things.
That's a fundamental difference.
Huge. And it means, usually, the Fed makes a pretty hefty profit. It creates money, buys assets like government bonds that pay interest. That interest income covers its operating costs. It pays a small dividend to its member banks, which are technically its shareholders' bank. And then the rest, which often used to be tens of billions of dollars a year, just gets handed over to the U.S. Treasury. Free money for the government, essentially.
Okay, but you said usually. That leads to this really strange situation right now, doesn't it? The Fed is actually losing money.
It is, technically. Yeah. And it's a direct result of that QE we just talked about, especially during COVID. They bought trillions of dollars worth of bonds when interest rates were near zero, so those bonds pay very little interest.
Right.
But now the Fed has raised interest rates significantly to fight inflation. So the interest it has to pay out to banks on their overnight deposits held at the Fed is much higher than the interest it's earning on all those low-yield bonds it bought earlier.
So income is low, expenses are high, leading to a loss.
Exactly. On paper, they've been reporting pretty large losses for the last couple of years.
Does that matter? Can the Fed go broke?
Well, this is where it gets tricky and kind of political. From a purely operational standpoint, no, it doesn't really matter. The Fed can't go broke in the way a normal company can because, remember, it can create its own money. These losses are basically just future profits it won't be sending to the Treasury. It's an accounting thing, reflecting money being taken out of circulation down the line.
But politically,
Politically, it's a different story. Headlines saying Fed loses billions. Sound terrible, right? It sounds like mismanagement, incompetence. It gives ammunition to critics who want to rein in the Fed's power or question its independence. What's fascinating here is how these, fairly technical financial details can become such potent political weapons. It highlights that constant tension around the Fed's role and its independence.
absolutely. And that brings us neatly to these modern challenges. It sounds like, despite being vital, central banking isn't exactly smooth sailing these days. You mentioned debt and inequality earlier, making their job harder. Can you expand on that? How do those actually interfere with what the Fed's trying to do?
Yeah, it's probably the biggest challenge they face right now in terms of just raw effectiveness. Think about monetary policy, like trying to balance a stick on your hand.
Oh,
Tiny little stick is really hard to balance. It wobbles too easily. But a huge, heavy telephone pole, that's also incredibly hard to keep upright because any small movement has massive consequences.
right.
Right now, with household debt, corporate debt, government debt, all at near record levels, the economy is like that heavy pole.
So small changes in interest rates have huge effects.
Exactly. Small rate hikes can suddenly make debt unsustainable for lots of households or businesses, potentially causing defaults or sharp spending cuts. It makes fine-tuning the economy incredibly difficult and risky. And then there's how inflation itself is playing out across different groups. The QE and low rates after COVID definitely pushed up consumer prices, the inflation we all feel. But asset prices, stocks, real estate went up way faster.
Right, you mentioned that.
Most of that new money didn't actually flow into everyday spending for most people. It ended up with wealthier households who use it to buy more assets, bidding up those prices. Now think about real estate again. Prices are sky high. If the Fed raises rates to fight consumer inflation, that also raises rates on commercial mortgages. So businesses might have to charge higher prices to cover their bigger loan payments or higher rents, which can actually add to inflation for consumers.
So raising rates could have the opposite effect in some areas.
In some specific markets, potentially, yes. It shows the limits of these broad tools. The Fed can definitely squeeze demand from, say, poorer households who rely on borrowing for cars or essentials. Raise rates, they borrow less, spend less. But they have much less direct control over wealthier households who maybe aren't borrowing much anyway and whose spending isn't very sensitive to interest rates. They just keep buying assets.
Which suggests the Fed's tools are hitting different parts of the economy very unevenly.
Deeply unevenly. And this feeds directly into inequality. It's not a new issue, but it's arguably become much more extreme since the pandemic. Central banks pumped trillions into the system, trying to save the economy. But a lot of that money effectively settled with those who already owned assets.
Making the rich richer, essentially.
That was a major side effect, yes. And now the Fed is trying to pull money out to fight inflation. But where can they squeeze? The easiest place to squeeze is people with debt mortgages, car loans, credit cards, who are often the less wealthy.
So the burden falls disproportionately.
It tends to. And beyond the social issues of having, gilded age levels of inequality, it just makes the economy incredibly hard to manage with the tools the Fed has. It's like trying to steer a ship where half the rudder is missing.
That really paints a picture of the difficulty. And you mentioned another major challenge, this growing conflict with governments and why independence is so key.
Right. It's related to everything we've discussed. The Fed isn't just managing one economy anymore. It feels like they're juggling three. You got the economy for the wealthy asset owners, the economy for regular working people, and then this increasingly huge chunk that is government spending and borrowing.
Government spending is that significant now?
Historically high, as a share of the economy, outside of major wars. And when the government is spending and borrowing so much, its actions have a massive impact that can easily work against what the central bank is trying to achieve.
Which is why independence is so important. So the Fed isn't just doing the government's bidding.
Absolutely critical. Politicians, almost by definition, operate on shorter timelines, election cycles. They usually want good economic news now. They might be tempted to push the central bank to keep rates low, even if inflation is becoming a problem, to boost short-term growth or make government borrowing cheaper. A truly independent central bank should be able to make unpopular decisions, like raising rates to control inflation, even if it slows the economy temporarily for the sake of long-term stability.
And we're seeing that conflict play out right now.
Oh, clearly. The Fed is trying its best to apply the brakes, raising rates, pulling back liquidity to fight inflation. Meanwhile, Fiscal policy, that's government spending and taxation, has largely been hitting the accelerator.
Yeah.
Spending remains very high, and we've seen major tax cuts enacted over recent years.
And you mentioned this isn't just one party.
No, the trend of expansionary fiscal policy, especially tax cuts alongside high spending, has been pretty consistent across different administrations recently. So you have monetary policy, the Fed, trying to slow things down, and fiscal policy, the government, effectively speeding things up. They're working against each other. It's like driving with one foot on the brake and the other flooring the gas.
Not exactly efficient. Which brings us back to that provocative idea mentioned at the start. Maybe the government doesn't need the Fed anymore. Could the Treasury just take over?
Technically, maybe. You could imagine a scenario where a really disciplined Treasury Department takes on the Fed's responsibilities, setting rates, managing liquidity. The mechanics aren't magic. They could theoretically be done elsewhere.
Yeah.
But the historical record is pretty clear. Central banks that lose their independence, that become subservient to political whims, and can't make those tough, unpopular calls, it almost always ends badly. Look at Turkey recently. The president insisted interest rates stay low despite soaring inflation, fired multiple central bank governors who disagreed.
And the result?
Hyperinflation, economic chaos. They thought they could just grow their way out of it, ignore the inflation warnings. It was a disaster they're still recovering from. History is littered with similar examples. Independence really matters for credibility and long-term stability.
Is there any check on the Fed chair's power within the system itself?
There is, actually. That's a small piece of good news, perhaps. The Fed chairman doesn't have absolute control. Remember, it's the Federal Reserve System. It's actually 12 regional Federal Reserve banks across the country. Each has its own president, its own board, its own research staff. Major policy decisions, like setting interest rates, are made by the Federal Open Market Committee, or FOMC, which includes the Board of Governors in Washington and 5 of the regional bank presidents on a rotating basis. So there's built-in debate and different perspectives.
Okay, so it's not just one person calling all the shots.
Not entirely, no. There are some internal checks and balances.
Right. Well, there you have it. We've really gone deep today, from the messy origins solving trade chaos to the tools the Fed uses and these huge modern challenges: debt, inequality, and those tricky political pressures.
It's crucial stuff to understand, really, because what central banks do or don't do has such a massive consequence on our everyday lives. Inflation, jobs, the cost of borrowing. It all connects back.
Absolutely. And thinking about the Fed's current weird situation, buying low-rate bonds, now technically losing money, but still operating fine because it can, well, make its own money. What does that unique power and the political arguments swirling around it really tell you about the nature of money itself and about power and influence in our economy today? Something to think about until our next deep dive.